Good day, everybody. Let's get started. Hope you're all well. My name is Emmett, Kilduff, the CEO of the Fortia Group. Welcome, everybody. There's still some people to dial in, but let's get started in the interest of time. Based on feedback from our last few webinars, we've tried to shorten our total webinar time. We've done webinars that were 90 minutes or 120 minutes in the past. So today is 60 minutes. We're cramming in a lot of content. We have six speakers giving 3-minute TED type talks each. We've asked them to sort of pack in a lot of the key points into a short amount of time, then have lots of remaining time for audience Q&A. So hopefully this format will work well today. So on our last webinar, we surveyed the audience and asked what topics did you want us to cover? This was the #1 voted topic, sources of capital. Obviously it's tough markets at the moment, no matter what sector one is in. And we're delighted today to bring together some great speakers to discuss this topic and answer your questions. So without further ado, let's jump in. Very briefly about the Fortia Group, some updates. For those that don't know us, all we do is focus on e-commerce M&A. That's all we think about every day. We have colleagues in the States, in Dublin, Ireland, in London and Berlin, and that's our focus. We work with all types of e-commerce companies, whether it's FBA, DTC, or otherwise logistics companies, SaaS companies linked to e-commerce. So please reach out if we can be helpful to help you think about your exit. Yesterday, we finally published edition 1 of our exit guide for DTC businesses. It's been in the works for at least 6 months. We're not the sole author. We bring in partners to help us write these types of documents. Contributors include material from Jefferies, and lots of content, advice and thoughts from leading DTC aggregators such as Peak 21, Pattern, eComplete, and so on. That guide is now downloadable from our website, thefortiagroup.com. The reason we publish it is because about a year ago, we produced the leading guide for Amazon FBA entrepreneurs. That's a 98-page guide written, co-authored with over 20 different aggregators and other experts in the space. So now we have a guide for FBA-led businesses and DTC-led businesses. Both of them are the best in the business. And we thank Swiftline, which is the owner of Yardline and Charm, for sponsoring our most recent guide. We also launched last week the first network for acquirers of e-commerce brands. This is a group on LinkedIn which will facilitate networking online and offline, as well as the sharing of interesting content related to folks that work in the e-commerce acquisition space, be they at an aggregator, DTC or FBA, a private equity firm or a strategic. We launched it last Thursday. There's already 55 members. They have to be C-suite or head of M&A. So it's a strong senior group of individuals. Last month, we hosted a half-day event and dinner in New York for 20 aggregators around the table. Our next event is in Amsterdam at the end of March. We'll be hosting a dinner there sponsored by Access Club for 30 acquirers, and we'll be back in New York in June for a bigger event. More info to follow on that. So if you are working at an aggregator or C-suite or head of M&A and you haven't joined the network, please reach out to me direct. We've been doing webinars for over a year and a half now. All of the webinars are recorded. So obviously it's difficult for people to take time out and watch these webinars live, but we do get hundreds and in some cases thousands of people reviewing the recordings on our YouTube channel. We'll post a link to that into the chat during the webinar, so you can subscribe and then get alerts to when the recording of this and other webinars are available. So today's webinar is all about capital. Delighted to have a great mix of speakers here representing both equity and credit side of the capital equation. Joanne, Hillery from Outfund, Ari Horowitz from Swiftline, Daniel Jacobini from Sidera Labs, Stephen Cooney from Wayflyer, and Chris Vigmond from Settle. So super lineup. What we'll do is we will give, I'll do a short introduction just to help give our thoughts, the Fortia Group's thoughts on the context of equity and credit. And then each of our speakers will give a 3-minute TED Talk type presentation, no pressure. And then we'll have lots of time for Q&A. Regarding Q&A, please submit questions as we go through today. Kindly use the Q&A tab on Zoom, not the chat tab. It's much easier for us to field questions and record answers via the Q&A tab. Okay, so from the Fortia Group's perspective, this is a chart I've used and used for many years. I started out in investment banking back in the year 2000, doing equity capital market, equity type deals from secondary rounds all the way through to IPO. And this applies more for DTC brands as opposed to FBA brands, but DTC brands typically follow this life cycle of equity fundraising from the initial fundraising from business angels or friends, family, or fools to get seed capital to get a business going, through to Series A, B, C, towards maybe mezzanine funding, and then ultimately an IPO. That's generally the typical life cycle. FBA brands, clearly slightly different. It's less cost to typically set up because Amazon has the customers, and typically there is some seed capital, but then they don't generally follow the traditional sort of unicorn or startup route of Series A, B, C, D. So there's a slight nuance there, but generally that's the approach. Quantum of deal flow and cash raised significantly declined last year, due to the difficult markets. I think that some of the best data relating to early stage deals, equity deals, is from Carta. And this graph shows that both the quantum of deals, which is the bar chart, and the dollar volume of deals, which is the line, has decreased significantly. The dollar value is down 50%, and you'd expect that to continue. That trend to be somewhat similar for the coming months. If we do a deeper dive, there's some really interesting data regarding the sector we all care about the most, e-commerce. This is a chart showing for seed rounds where the sector ranks in terms of cash raised and the valuation. So you can see it, unfortunately, down on the bottom left. E-commerce is the 24th category in terms of cash raised. So right now, that's not where the cash is going. And from a valuation perspective, it's better than maybe one would have thought. It's ranking 13th. So that's a seed stage. It's very similar if you look at Series A stage. Our sector, e-commerce, is also the 24th ranked. So it's not top of generalist investors, be they seed or VCs at the moment. For some obvious reasons. I think ever since the iOS change in summer 2021, a lot of the VCs haven't been as supportive or as interested in the e-commerce sector. So that's a difficult place for us all to be, given especially if you're a DTC company looking to raise equity. We'll talk about that more with Sidera Labs later on the webinar. If the equity markets are as tough as nearly 2008, and particularly for e-commerce, like, where does that leave a lot of entrepreneurs? I think the credit sources are probably the most accessible right now. There's a range of sources, and we go into these in a lot more detail in our new DTC guide. And of course, all the speakers today cover a lot of these, so they'll go into more detail. There's various considerations to think about as an entrepreneur when you're looking at all these different options, from the actual indicative rate to how flexible payments are, to whether you need collateral, whether they're flexible in terms of use of funds. And I think certainly the RBFs are getting increasingly flexible, and how quickly decisions can be made. We'd be delighted to talk all these options through with any of the prospects or e-commerce folks that want to explore all their options of credit. But without further ado, then let's move on, and we'll dive deeper into all of these with our speakers who live and breathe each of these on a daily basis. So I'd like to welcome to the floor Chris Vigmond of Settle. Are you there, Chris?
Yes, sir.
Great. Over to you.
Thank you. Great data to start us off. Thank you very much. So yes, I'm at Settle. Company was started by Alec Koenig, who was head of credit at a firm for 5 years. Company was started in 2019. It's at Clearco for 3.5 years, which is another revenue-based financing solution. and recently came over to settle in middle December. So that's enough about me. I have a few slides that I've prepared. So Emmett, if you can just move forward. Perfect. So I mentioned I was at Clearco for 3.5 years. Clearco is largely based around investing in your marketing spend to grow your valuation. Settle has marketing spend as well, but their core focus is actually on the supply chain and how we can help large cash outflows for your business within that supply chain. And so what this graph here is showing you, or this timeline, sorry, is on day 0, actually prior to this even timeline, a lot of companies are going to get POs from large retailers, large distributors. And then once they get that PO, they're going to go to a manufacturer. During 2020, during COVID, it was largely 100% of the capital was due upfront to your manufacturer. That's largely now split 50-50 or 30 and 70 upon receipt. But what this graph here is showing you is that as a business, there's a tremendous amount of capital that's expected from you to your vendors during certain points of the timeline. So on day 0, you owe 30%. On day 70, when the manufacturer releases it to you, to transit, then that's the additional 70%. Once it lands on day 65, this is a rough timeline here. Uncle Sam, they take their piece as well. Once that lands in your to your warehouse, you have to pay the freight forwarder, if you will. And so you can go to the next slide, please. Thank you. So in Go terms, this might be a little bit dated. I think this is from 2022. They usually come out every 1 or 2 years. This is really our bread and butter and where we add value to our customers at Settle. And so if you look at the y-axis, you're looking at like payment terms with your vendor. And if you look at the top with all the icons there, you're looking at like the timeline of where your product is in the supply chain. And the intersection of the orange, which is the seller's responsibility, and the blue, which is the buyer's responsibility, you'll see often at this intersection is a risk transfer. And so that's otherwise known as like, that's when money is due. And so if you are a business doing $2 to $5 million, you're probably going to be living in the top third of this chart here in terms of terms with your vendors. And so there's a massive difference between having net zero on EXW with your vendor versus a company like a Caraway or a Nike or a Branch or somebody that is their supplier. Branch has 100% of their supplier's business or 80%, a good chunk of it, to where the supplier is willing to take the risk. And so where Settle fits in nicely is in the top third here, the $2 to $20 million brand that doesn't yet have that power in negotiation with your vendor to say, okay, cool, net 365 or whatever those terms look like. If you look at a DDP at the bottom here, you will see that the seller actually carries all of the responsibility up until the destination when the product lands. And so what we're here to do is to just alleviate cash flow constraints of the supply chain. And as mentioned, we live in the $2 to $20 million range in terms of businesses that we help the best. Next slide. So this is a slide that we show all of our customers, and this is really what we're designed for, is to help that company that might be launching a new product, in a new market, so on and so forth. And again, doesn't have those terms with their suppliers yet. And so what we do is we pay your vendor on day 1, and the e-commerce brand will pay us back anywhere between 30 days and 180 days, depending on your terms you have with your suppliers and the needs that you have as well. And so you can see what we're trying to do here is to solve this cash flow gap to where you're only paying on a certain, like a bullet style structure until your product lands and you're selling it, at which point then you can start paying Settle back. So those are the 3 slides that I wanted to bring today. If you have any supply chain cash flow constraints, we're always open for a conversation. And we are also working with a number of aggregators to find operational efficiencies across a number of subsidiary brands, or actually at the holdco level as well. So I'll pause there.
Chris, thank you for that talk and for keeping on time. We'll do Q&A after all the other talks. Brilliant. So let's go from Canada to here in Ireland and over to Joanne.
Hello. Yeah, thank you so much for having me. It's a pleasure to speak with you all today on the topic of funding in today's very challenging market. But yeah, so I'll dive right in. I think, as Emmett mentioned, we all know the challenges that businesses are facing over the last number of years, like with COVID, supply chain challenges, rising interest rates, the Ukraine war, inflation, increased raw material costs. Like the list, unfortunately, is quite extensive. So I wanted to share with you some really interesting trends that we're seeing in Outfund that might help some of the founders on the call. So firstly, yes, you can go to the next slide. Brilliant. Okay. So the founders that we're backing in Outfund. So Outfund is a revenue-based financing company that's headquartered in the UK, operates globally. The founders that we're backing, what we're seeing is these founders are really focused on enhancing their margins and their cash flows. Look, we all know that it's no longer a growth at all cost market. And what we really want to see is founders focusing on getting the right unit economics. So we want to see healthy gross profit margins, strong ROAS. Do they have cash in the bank? Is there positive cash flow? Like these are all really, really important. Revenue is obviously there, but it's not the sole contender for your funding. But again, I just want to say not to lose sight of kind of opportunity that we know will always exist within recessions. So we're seeing some founders right now that are making some really smart moves. So like taking funding for ramping up marketing if they know some of their competitors have pulled back, or buying up stock at discounts to eliminate competitors. And I think this is what is clearly evident now is there's a new generation of really resilient founders who understand the real importance of A, profitability, and B, remaining agile. And you can pop to the next slide. And secondly, the kind of theme that I wanted to share was around the importance of looking at all sources of capital available to you and trying to use a mix of these to suit your needs. So we know there are so many different types, as Chris just mentioned, supply chain finance, like I've written out a list of them here. There's so many available. And actually what's so important to note is they're always constantly evolving and innovating. So for example, in Outfund, just this month, we increased our payback term from 6 to 12 months. We removed the restriction of what we use for capital. As Emmett mentioned, a lot of these restrictions are now kind of getting a lot more flexible. And we also actually give cash in bank. So none of these options were there, if you had spoken to us a couple of months ago. So what I'd say is like really make sure that you're speaking with your network and that you're aware of what kind of changes are happening. And we also see like a really strong CFO when we're dealing with them. We're speaking to them day in, day out. And a really strong CFO is one that we see is using multiple sources of financing to suit their various needs. So having the confidence to kind of have a mix. So hedging risk amongst your capital providers, we're seeing is really providing the best long-term results. So platforms these days, they're intuitive. Don't be put off, but know that your funding partners, they can work together. And what Emmett mentioned at the beginning is so important. It's really about thinking, what matters to you most? Is it the certainty of cost in today's market, or is it the speed of funding? How much do you need? Are you comfortable with giving away a percentage of your business or board seats or putting up collateral, etc.? So what I'd say is I really think about, the pros and cons to all sources of financing, and then think, okay, it does not need to be a one size fits all. And I think I'll try and just do a quick summary there to keep within my time. So what I really would advise is make sure that you're all over your numbers and that you keep seeking out new opportunities until you find the right fit and the right mix. That's it.
Very good. Thank you, Joanne.
No problem.
Thanks for staying to time. Okay, we're going to go back from Ireland. We're going to go back across the Atlantic to Daniel in New York. Over to you, Daniel.
Thanks, Emmett. And yeah, great data. I think to your point, e-commerce is no longer about unicorns and hyperscaling. And to Joanne's points, it's not about growth at all costs. So very quick background. Sidera is an early stage VC fund. We focus on helping brands find that long-term healthy growth. And this ends up looking like more growth equity for young brands than what old guard VC might sound like. If you could switch to the next slide. So I think in addition to really knowing your metrics cold, the big thing we think founders need to focus on is nailing that use of proceeds. As much as investors or capital allocators, founders have to allocate, whether it's their retained earnings or investment capital to their operating initiatives. So the way we think about this is it sort of boils down to a series of questions. Maybe to even simplify my 4 questions into 2 is, what is your ROI on what you're hoping to raise for? And what is your payback timeline? If you know your ROI, you'll really have a really strong understanding of the value of that investment capital that you're seeking. And if you can understand that payback timeline, that'll actually help you determine what source of capital is the best fit. Is it an equity product or is it a credit product? We tend to find that equity is best for larger strategic bets that you're hoping to make, while credit might be best fit for more working capital financing needs. Emmett, if you could flip to the next one. And if you're anything like myself, I've spent a lot of time watching YouTube videos and reading case studies and hoping to identify, right, what is the commonality to brands that have scaled. And honestly, what we've found is the main commonality has been taking a bootstrap mindset. So as you're going through the capital fundraising process, we try and boil this down to, how can you think about, taking a longevity approach to not having cash flow burn or needing to raise that next round in the next few months, and building optionality to raise your round at your own terms. So it really starts with auditing your spending and managing your cash flow. Once you have a good understanding of your own cash flow, you can start to run experiments. Those experiments may be a fit for equity capital, right? How can you identify that next growth channel or that next sales channel? Or you could do that off of that bootstrapping mindset. And then as you go about that, if you're hunting for that long-term sustainable growth, you'll eventually identify your target persona and the marketing channels that best work for your brand. So maybe to just summarize up the way we think about things is, have a really intense understanding of your metrics and that use of proceeds, map out your ROIs, understand your payback timelines, and that'll put you in a really strong position when talking with both equity and credit capital providers.
Great. Thank you, Daniel, for also sticking to time. Great. So we'll come back across the Atlantic again to land in Ireland, and Stephen Cooney will just chat on behalf of Wayflyer. Stephen, are you there? Are you there, Stephen? Are you on mute?
No. I'm here. Fine.
Great.
You missed some bits there. I was just thanking you for having me on, Emmett. I'm in London currently. Really good insight shared by everyone. So thanks for sharing. I'm going to try and keep it brief with my comments. Wayflyer, I'm not really going to be speaking too much specifically about Wayflyer, but we've been around for 3 years, giving out over $2 billion to over 2,000 e-commerce brands globally. And we've seen great success and a lot of happy founders. And we're on a mission to continue to keep them happy and empower e-commerce founders and CFOs. So we can talk a little bit about that later. But what I really wanted to talk about today is learning from individuals who are the greatest in their field. And I'm going to talk today about 2 lessons imparted upon us by individuals who are masters at their craft. And these 2 simple lessons, I think, and we at Wayflyer think, are fundamentally important to your business for 2023, challenging market, as we've highlighted already, and beyond. So we go to the first slide. What does Warren Buffett, the world's greatest investor, teach us about credit investing in the e-commerce space? Well, one of his most famous quotes, and he's got hundreds of great quotes, is price is what you pay and value is what you get. And we think this lesson is particularly important when you're considering options in the credit space or the funding space, the working capital funding space for e-commerce businesses. Of course, the price that you pay for your funding is incredibly important. It's the most important thing when making a decision, in particular with credit or any form of funding. But looking at price from a one-dimensional perspective, what I mean by that is looking solely at the lowest APRs or trying to get the longest payback periods, we think is a big mistake people make, that they live to regret. And we've seen it a number of times, many times from really, really great businesses. And the reason for that is e-commerce businesses, we all know they face a very specific set of pain points when it comes to financing, in particular working capital, and focusing on solving those pain points in the most cost-efficient manner and thinking a little bit more long-term than short-term is the only way to really create value, we think, and scale a business sustainably over time. So instead of focusing on that one-dimensional number, focus on absolute dollar cost of funding to your profit and loss, because as a business, that's what you're going to be judged at the end of the year. Focus on flexibility of the solution that's being provided. Focus on matching the actual funding to your inventory cycle, in particular when you're trying to solve a working capital issue. There's no need for very long payback periods. In fact, that gets in the way of your next inventory cycle because you won't be able to pay it back as they stack up. Reducing your cash conversion cycle should be key as a founder. That should be what people are obsessed with in the e-commerce space. So think about all these things, hidden costs, unneeded lock-in charges, just mind space, like the ease of dealing with a company, opportunity costs. If you commit to one financing type, what is the opportunity cost that you're giving up further down the road? And again, we've worked with the fastest growing companies in the world, the most exciting direct-to-consumer businesses. Most of them get this, some of them don't. Some of them come back to us with very long payment periods, and they regret it because they're attached to that kind of short-term decision. So the first point I want to make of 2 points is don't just focus on the price, focus on the value, and focus on the full picture. So the next slide, if we can move on to that, Emmett, is, well, the question I want to kind of start with is, what does the world's greatest hockey player teach us about financing e-commerce businesses? I lived in Canada for 6 years, and Wayne Gretzky is the big hero of the country there, known as the chosen one. He's hands down the greatest ice hockey player of all time. And he was known for his ability to move around the hockey rink. And he's got a famous quote that's on the screen here. It says, "I skate to where the puck is going to be." Why I think that is relevant is, instead of being reactive when it comes to financing, it's really, really important to be proactive. So that's what Wayne was on the hockey rink. He had an incredible ability to understand where the plays were going to be. So we meet with hundreds of great founders a month, and there is a common theme, and this lesson is particularly important today. Undoubtedly sentiment has changed, and there is an air of cautiousness. And a lot of them are saying, I've got cash reserves, I don't need financing right now, I've got 9 months of runway, I'll come back to you in 6 months. And the reality of the situation when it comes to working capital financing, coming from Wayflyer, is that when you come to that stage, you're too late. We need you to be in a situation where you're in very, very good standing or good standing to have the best chance of taking financing, in particular in this market. So what I would say is, when it comes to financing, you are better off looking at it than looking for it. And our founders have a great saying that they always say the best time to raise capital is when you actually don't need capital. So skate to where the puck is going to be. That's the big lesson there. So just in terms of summing up on the last slide, Emmett, those are the two big takeaways. Focus on value and price, not just an APR. Focus on the dollar cost of the funding over the calendar year when it comes to working capital, because if you're taking a very long funding term structures, you're going to be paying a lot of dollars for that, even though the APR is low. and then be really proactive about talking to different providers about funding ahead of time, not when you're on the back foot. So,
Great.
Cheers.
Thank you, Stephen. Thank you very much. Right, so we'll go back across the Atlantic to Ari Horowitz in New York. Welcome, Ari, over to you.
Thank you. Thanks, Emmett, for having me here. Thanks for letting us sponsor the latest report. We're excited by that. And just quick background on Swiftline. A number of us have been in the e-commerce space for a long time. Team came from a company called Thrasio, one of the early players in the FBA space, aggregators in the FBA space. Swiftline was set up to acquire e-commerce SaaS businesses. So we are an infrastructure platform for doing that. We also acquired recently 2 foundational assets, one of them being Yardline Capital, which is a marketplace to help find capital for DTC and FBA sellers. And then the second one is a company called Charm.io, which provides data around both e-commerce ecosystem, brands and e-commerce ecosystem. You can jump to my first slide. I'm going to try to share some of what I've learned over the course of the past 30 years, being both a buyer and a seller of capital, which at the end of the day, we're talking specifically around equity financing, and I think debt financing as well. Most of you are going to be looking to be buyers of capital. So, good to get in the head of the sellers of capital to understand how they're thinking and hopefully make a more compelling pitch. What I've tried to do here is list out a number of the different channels to find capital. I know Emmett put up a great chart that sort of showed the phasing and where these different opportunities come into play. I've added something that probably doesn't really fit, but one of the things I'll point out here that wasn't addressed was looking at different ways of getting the financing. One of them right now in a tough market, being a safe or convertible note. For those of you not familiar with that, sort of sits somewhat in front of a venture capital opportunity where you push off the actual price to a future event. Hopefully when valuations or multiples have gotten better, it's something that's usually better for the buyer of the capital, and the sellers of the capital would like to get their price today when things aren't as attractive. But without going too much detail into these, one thing I will point out on here is that on the venture capital side, there's been some good information shared here on the webinar. I will say that can be a massive time suck, especially in a market like this. So just something to be careful of. There's teams that are inside of these companies that are just dedicated to getting as much information as they can out of you by dangling the prospect of investing in your business. I've been on, I'm sure many of us have, the receiving end of those emails. It's usually a associate that just joined the firm that's tasked with just sucking information, will take up a lot of your time without really there ever being a high probability of getting capital. So my cautionary tale there, my advice is just be careful of those. And if you're going to take these calls, just make sure there's a partner on the call and you're not just giving them information, but you're actually, that'll flush out if they're really interested. Also, just on this slide, one thing to point out is, a lot of people think that in a terrible market like this or a tough market, it's not a good time to sell. I would also take the contrarian approach to that, in that if there are buyers out there and certainly valuations have come down, but think about what you can do with the capital after you get it, and you might be able to put that into something that shows outsized returns, and net, you might be doing better. So something not to take off the table in a tough market. Can you pop to the next slide, please? So these are, a lot of this has been covered. These are the different channels for debt financing. As I mentioned, Yardline sort of helps sort through a lot of these. That's why we set up that platform. I do think that the complexity that we've heard around both the equity and the debt financing options, it's probably a good idea to get a third party involved, unless you're very sophisticated or have teams that are very sophisticated around this. You won't pay more. Typically, the fees that these third parties get are paid by the provider of the capital. So it typically will behoove you to seek that advice and to navigate this landscape. I will say that when it comes to either equity financing or debt financing, there's a couple of dynamics that may work in your favor as well. On the debt financing side, there's going to be players that want to grab market share. So if you happen to find the right company that's looking to build a portfolio of your type of company, you could get more attractive pricing because they're looking to build market share, and you're a catalyst for that. I'll also say that on the equity financing and maybe the debt financing side, finding strategic partners where you add some value, and or a vendor who is looking to make money from you in other ways to provide you with financing, can help with lowering your financing rates because they're really making the money on some other mechanism, potentially like a shipping, put the Flexport capital up there. They're going to make money. The more money you have to spend with them on shipping or inventory, the more money they make. And so the capital becomes a lead source for their core business. So I think those are good places to look. And that's a good 3-minute overview on what I've learned over the past 30 years.
30 years into 3 minutes. Well done, Harry. That's not easy. We'll have lots of time for Q&A. So let's jump into Q&A. If all the speakers can please turn on your cameras and your audio. So to kick off, a question about the ratio of applications to transactions. Roughly what is that, and what trends are you seeing in terms of the number of people applying for a loan to what you're actually giving out? Who'd like to start?
Well, if no one else wants to raise their hand on that one, I'm happy to jump in. I don't have exact numbers on that. I think the way to look at that goes back to what I was talking about before, is if you fit the sweet spot of what someone's looking for, or they're trying to build market share around your category, you're going to do better. So I think this once again gets into the idea that, hey, let's put your sort of thought into what is this person who's trying to sell me capital thinking, and what are they trying to accomplish here beyond just getting a return. And anyone that's going to lend you money or invest in your business with equity, it's all a risk reward ratio that they're looking at. Obviously, the riskier the asset, the more return they're going to be looking for. So if you understand the seller of the capital, I think you get a better shot at getting converted.
Yeah, I just jump in, Emmett. I don't have the exact figure. I know that right now around 50% of our merchants that are put into underwriting take capital, whether that's they don't make a true underwriting, or they find a deal that they think is more attractive, or maybe they push off the financing piece for a little bit, as I kind of mentioned earlier. I would say one thing that we're really, really good at Wayflyer is getting very, very fast answers back to people. So part of our process is connecting data sources. We're really, really strong with data, hence our relationship with JP Chase. So that's the kind of first step of the process. But normally we have a consultation call before that step of the process. So there's a lot of guidance to brands before they even connect up their data sources. So the idea at Wayflyer is not only to be very quick with giving out funding, but also very quick at kind of getting back with an answer, just so it's not taking up a huge amount of mind share for the founder.
Thank you. There's a question for you, Stephen. Big e-commerce brands have everything they need from the banks. Why would they use an alternative provider?
Very good question. I would say, Wayflyer, we've been around for 3 years. I kind of gave you the Coles notes earlier. We've moved upstream significantly over the last year and a half. We started with 20K a month minimums, and now we're funding brands that make $200-300 million a year. And the reason for that is that there's incredible appetite for flexible solutions that allow companies capitalize on opportunities. Again, through our relationship with JP Chase, which, just to hammer out, that we have a warehouse line with 2 top tier 1 banks, global names in the space, giving us a very low cost of capital. They sometimes send us on companies that need financing beyond their ABL. So asset-backed loans, which is a traditional source of finance, which was never really built for e-commerce brands. It only works to a certain extent in the e-commerce space. And again, coming back to that APR, asset-backed loans have very low APRs, but they also have very strict covenants on the actual terms of those credit facilities. So you have to hold a huge amount of inventory in your fulfillment center, which is counterintuitive if you're trying to solve a working capital solution. having stock in your warehouse to buy more stock makes no sense, when in fact you want to be turning over your stock as quickly as possible and reducing that cash conversion cycle. So the big thing that these big brands are looking for is speed, unrestricted capital into their bank accounts, and the ability to kind of come back when they need and get decisions turned around and financing within, call it 2 or 3 days. And that could be anywhere up to, I think our biggest advance ever was $35 million, and that took a handful of days.
Yeah, I'll add to that too. I think that's a great explanation, but also I just don't think the banks are set up to deal with e-commerce at all when it comes to the smaller businesses. If you don't have assets and you're looking to do revenue-based financing, you want to go to companies that understand it. And my sense of living in it for the last 3 years has been that they just really don't, and that's why companies like Wayflyer and Yardbine and others can exist, because it's we understand the business, we've lived in it, and we know how to navigate through it. I mean, walk in there and hand them that. The first question we'll ask you is, well, give us a copy of your lease. We don't have one, right? And well, how many employees do you have? Well, it's just me, right? I mean, the answer, they don't like those answers out of the gate. So.
Yeah, I'm going through a mortgage application at the moment. It is seriously painful, so I can only imagine the conversations they have.
I can't help you in Ireland, but I got some good contacts in the US.
If I can just pop onto that one, Joe or Joseph, the way that I like to look at the revenue-based financing players that are still around and excelling in today's environment is like the tech piece of a bank. They have very solid backing from tier 1 banks, as Stephen had mentioned, and we are the tech piece behind it that can give you these offers right up front versus giving you a lease or something like that a bank's going to take. A bank's going to take 1 to 2 months. And a company like a revenue-based financing player, they have those banking relationships, so the cost of capital the capital is stable. We're just able to give it to you a lot faster than you traditionally would be if you went into the bank and tried to secure that loan from the bank.
Mm-hmm. What about rates? Rates have obviously, have increased and are probably going to increase further before they decrease. How is that affecting, the rates you're giving and the defaults you're seeing? Maybe bring in Joanne on that one.
I think so. Being in places like Outfund and Clearco, I think with revenue-based financing, the fact that you can offer a certainty, a fixed fee, is what's so popular about this type of funding. I think, knowing that there's rising interest rates and what's happening kind of in the market every couple of months with rising interest rates, it is quite an uncertain market. So I think that probably is why we have all of these big relationships with banks, and we can have that security of cost so that people know, okay, I'm going to take this out for 6 months to 12 months. And that certainty of a fee is what's really, really popular and really kind of comforting to founders to kind of go, okay, this is the cash amount that I'm going to spend on that. And I can bank that off now. And then also I'm not sitting there with crippling debt that might be sitting there for a couple of years. I can actually go into my strong seasonal period and work through and pay off this loan. So it actually, my books look really good at the other end of it, and I'm not sitting there with this debt. So I think the fact that we have locked in fees with big banks gives us a real competitive advantage to be able to offer them that and pass that on to the customer.
You mentioned the word seasonal. There's a question about seasonality. I mean, like, one of the most seasonal businesses I saw was a business in Germany selling lederhosen, the sort of the gear for going to the Munich Beer Festival, which applies to, sort of 2 weeks per year. How difficult is it for seasonal businesses to get credit, or equity for that matter? We're on the spectrum of seasonality. Do your ICs, do your investment committees just, not support really seasonal businesses?
Well, I think I can just say really briefly that it's about looking at history and trends. If you've seen that the business has been in operation for a very long time, and we can really back that up by their historicals. They have a strong community. They might have strong, socials, the number of followers, everything like that is kind of taken into account. And then when you're coming in, off the back of a period, it mightn't be a great time to get funding, but coming into a period like that, when you can see, okay, they're about to come into this strong sales period, it never really is a problem.
Yeah. What about acquisition financing? Any of you you all provide acquisition finance?
Look, at the end of the day, if you have the collateral in the back end or you have the revenue to support it, you can typically use the capital. In some instances, at least for what we did at Yorkline, you can use the capital for whatever you want. So if you can use that to acquire, certainly something we could look at. And I think that, it's the same analysis, right? If you're acquiring a good asset that is producing cash flow and or producing revenue that's financeable, that should go into the underwriting, and certainly something that you should bring to the table if you're looking for capital, if you have something like that on your LOI.
If I can add to the seasonality question really quickly, I think on the equity side, what we see is, our ability to do, more of a hands-on underwriting. That's what allows you to go beyond a credit limit or a credit line that you might see from a lender, is that, we can go into your marketing data or some of your other company-based data and say, okay, well, we see reason why, you can sell through 2x the inventory or 3x the inventory you did year prior. Whereas certain historical estimates you might get more, but it still might be limited.
What are some of the rates and sort of trends in rates you're seeing at the moment?
Look, rates, the cost of capital has gone up for everyone. So when we get into the source, unless you own a bank, and if you own a bank, the cost of capital's going up because you got to pay for that money. So typically, the rates are clearly going to be passed on to the e-commerce operators, and also, there's the risk profile, and as things are starting to stabilize a little bit, especially in the revenue-based financing. To my point earlier, it's all risk reward focused. So as things start to stabilize and get more comfortable with the future revenues of your business, the rate should reflect that. In very unstable times, it's risky. You don't know if you're going to get paid back. So the rates need to reflect that as well.
Anyone else want to comment on that?
Yeah, I could speak on behalf of Wayflyer, obviously. Obviously interest rates have gone up. That's affecting everyone. It's all relative. That's the point that Ari just made there. Our rates are, it really depends on risk and the size of your business. One of the things that we're really good at, again, is data. So we use 4 pillars of data, both historical and forward-looking data. We use your marketing channels. We figure out we're really good at forecasting your revenues. And again, we've proven that out over time with less than 1% default rates, over 3 years. In fact, I think it's less than 50 basis points defaults. So we're really good at doing it. So, we charge between 90 basis points and 120 basis points, depending on the size of your business, really. A month, that is. And again, coming back to why that's an important figure is because we structure it in a way that you're coming to us, you've figured out what your inventory cycle is, you know what the pain point is, or else we help you understand what the pain point is. We solve the problem, and then you come back to us a couple months down the road. We have brands who've taken 9, 10, 12 advances from us over a handful of years, and very, very happy because the dollar cost of that funding is not a huge amount versus if you were to go and take this big long line. So that's what we think works. And then as you move upstream, we have something that looks very similar to a line of credit, which is priced very, very attractively as well, in around that 90 basis points to 100 space.
Thank you, Stephen. There's a question that maybe you could type the answer to from Luke in the Q&A button. What are some of the maybe counterintuitive red flags that e-commerce entrepreneurs tend to overlook when they're applying for equity or credit to you guys?
Emmett, can you repeat that question? Sorry.
What do e-commerce entrepreneurs overlook? What are some red flags that might appear in your IC meetings that maybe folks don't really realize you're going to be thinking about and focusing on?
For us, there's a couple of simple ones. Having counterintuitive, but having cash on hand, having inventory on hand. Those are two really important ones. So if you come to us with no cash, and really two types of businesses that come to us: ones that need cash desperately, which unfortunately we can't finance, other people can, or ones who don't need cash but are preparing themselves. They know that they need cash, but they don't desperately need it, and they're kind of putting themselves in a position to continue to scale and not use their cash reserves over the next couple of months. And then obviously inventory, because revenue-based finance, the way it works, we start pulling down once the cash goes into your bank account. So it's important that you're actually selling goods and making sales so that we can get it back.
So maybe
on the equity side, really briefly, again, not to go back to my earlier little talk, but we really scrutinize use of proceeds, because when we look at founders who might want to raise a really big round, and they're saying they want to use it for marketing or for inventory, we really say, well, what is necessary, right? What they're asking for today going to be indicative of how they're going to run the business long term? Can they do the round with some equity and some credit, right? And I think thinking through that gives us a behavioral understanding of how they're going to run the business. And it allows us to partner more deeply as we think about, becoming somebody on the cap table with you.
So as we look ahead, then I'll ask you each for your predictions for 2023, purely from a sources of capital perspective. What trends are you seeing? What's your main prediction for the year? Who'd like to lead?
I'm happy to kick that off since I batted last in there. So look, I think you got to look at the macro environment here, and just again fundamentals. We have the public markets have certainly come back a lot more aggressively than the private markets, and so if you think about from an LP perspective, who is providing capital to the private market people who are funding companies, they now have an outsized, their portfolio is effectively outsized in the private versus the public. So they're going to be less inclined to put more money behind private investors, which means there's a smaller supply, which means that the capital is more expensive, if not there at all. And I think we got to flush through that. So my 2023 prediction, or and I'm sort of talking about my own book a little bit since we're set up to do this, is that we will see more declines in the private markets that need to catch up to the public markets before we see a turn.
Chris?
Yeah, if I may, Ari, I sort of dovetail off that. I think what we saw at the end of last year, or predominantly almost a full year, is that it was very expensive to raise venture capital, and that a lot of the revenue-based financing, invoice funding solutions are becoming popular because you can weather the storm by finding other solutions outside of venture. And so I think the prediction, which is not groundbreaking, but I'm seeing the signs, as Ari had just mentioned, on the private side in the D clients, is continuing to weather the storm with efficient capital until the private markets start to recover, to when you can then go raise that venture debt for the more institutional things like hiring staff or launching new markets, not inventory purchases and marketing spend. Like all the revenue-based financing players on this call are all set up for to support businesses. So I think it's going to continue to be expensive, and companies are going to continue to look at solutions like Settle, like Wayflyer, like Yardline to support their business.
Thank you, Chris.
One thing I'll jump in with, Emmett, and those are both very good points, is obviously we're potentially going into a market that, well, we're already seeing it in the data, cautiousness and kind of a little bit of a pullback in consumer sentiment. But in these markets, the strong get stronger and the weak get weaker. And what I mean by that is consolidation of competitors in certain verticals, but also when it comes to the likes of revenue-based financing, there's been a huge amount of market entrance over the last couple of years. It's a very, very hot space, a lot of equity raises to do with it. Economies of scale will win. Running prudent businesses will win. Building your business for the long term and doing the right thing for merchants, not being overly aggressive just to win business. So I would say that there's going to be a consolidation in that space too. And it's really important to know who you're partnering with, who they're partnering with, and knowing that they're going to be around for the long term, because there has been companies that have moved into geographies and had to pull out of geography who promise funding and never gave funding, and that's a nightmare for, you know, people don't think about the founders who have their capital locked up in these contracts that they thought would be honored to them. So that is something that really needs to be thought about by e-commerce CEOs, founders, CFOs over the next year or two.
It's actually the same. We're seeing this same trend with aggregators. A lot of aggregators are no longer around or are in trouble or not paying earnouts. So it's a two-way interview process. Sometimes it seems like it's one way, but it should be two-way.
If I can maybe go next and add to these points, I think definitely fundamentals makes a ton of sense, and we're seeing that as well. Yeah, consolidation in the service provider space, but I think of the players that remain, you're seeing greater optionality. Right. So Settle is a great example of moving into that supply chain financing, right? Expanding that, credit stack that exists. Sidera is a new example of how equity markets are evolving to have more options. And then I think the presence of the D2C guide itself is an example of the aggregator space and the acquisition space really looking for where is the next leg of growth. And, you know, it's been off Amazon, it's been direct to consumer, and I think that will continue.
Thank you, sir.
And then lastly, I'll jump in.
Yep.
Nope. I think it's largely what, has been mentioned before. I think a lot of the e-commerce founders, they've been holding back the last couple of years because of everything that's been happening, and they're ready to kind of accelerate their, their growth plans that they have. So there will be a real need for funding, but I think that need for the valuations, they will probably try and not go down that road because they'll be worried about will they get the right valuation. So I do see the likes of revenue-based financing, all of these kind of alternative types becoming a real strong asset class, because there's so much capital there. I know from Outfund's perspective, they're really ready to kind of pump into the market this year. So I think we will see them become a stronger asset class in the game.
Very good. Thank you, Joanne, and all the speakers. I think we're sort of 1 minute left, so we'll finish there. A reminder to everyone that this recording is available on our YouTube channel, which you can subscribe to get alerts of all future recordings. And today's materials will be circulated as part of the follow-up tomorrow. So with that, I'd like to thank all the speakers from today, Daniel, Ari, Chris, Stephen, and Joanne. Appreciate your time and effort and your TED-type talks. Well done, and thank you for answering all the questions. Have a lovely day, everybody. Thank you.
Thanks, Emmett. Thanks for having us.
Thanks, Emmett.
Thank you.
Thank you.
Bye.
Bye.